Welcome. I'm Priscilla Look from the S&P Dow Jones Indices. Today, we are very happy to have Blue Putnam, Managing Director and Chief Economist of the CME Group, to share his economic outlook on the Asian and emerging markets in 2016. Blue, thank you for joining us.
Oh, thank you.
The equity markets in Asia has been pretty depressing so far this year, especially the Chinese equity markets. What is your economic outlook on China in 2016?
Well, you know, China's slowing down. Everybody knows that. Took them a while. So equity markets are really coming to a more realistic view that China's going to grow much slower over the next couple of years and even slower in the next decade. And so we just have to be more realistic. And so there's a correction going on to adjust to that.
All right. So how about the currency market? Do you expect the Chinese yuan is going to depreciate further, or it should stabilize a bit? And how would that impact the growth of China, or especially its export sector?
Yes, the Chinese yuan is a very interesting currency because it's a highly managed currency. But Chinese exports have stopped growing. The problem is not China's fault. It's that the rest of the world is not growing very fast. You know, the U.S. 2%, Europe 1%, Brazil's in recession, Russia's in recession. So if your clients aren't growing, you're not going to sell them much. And so exports are stagnant for the reason of slow global growth. But when exports stagnate, a country like China will see capital outflows. And those capital outflows can weaken the currency. Or China can intervene to spend some of their foreign reserves to kind of slow down the volatility. But the direction is for a weaker Chinese yuan over the course of the next 2 years. It'll come in fits and starts. The Chinese want to manage the volatility more than the direction, I think.
So it seems like the investors should be patient a bit about all these things. So how about Japan, the other biggest economy in Asia? The Japanese government obviously has trying the best to stimulate the growth. And what do you think the challenges for them in 2016 to grow their economy?
Well, the big problem that Japan has is that it doesn't have any policy tools to deal with the long-run problems it faces. And basically, Japan has no population growth. It has no labor force growth. So all of its GDP growth has to come from increases in labor productivity. And you can get that by investing more in capital or technology improvement, but it's very, very hard on average to get more than 1.5% a year additional growth. And so no labor force growth, 1.5 from labor productivity. So Japan is a potential long-run 1.5% economy. So when they try to do better, it rarely works. The other problem Japan has is that it's an aging population. Now this is happening in China, it's happening in the US, it's in Europe, but Japan is kind of leading the way. And the over 65 crowd doesn't spend as much money as the younger working people. So the consumption per capita is actually declining, and that's a drag on the economy. And there's nothing monetary policy can do, there's nothing fiscal policy can do to fix the demographic issues that Japan faces. They just have to get much more realistic, which they haven't yet.
Okay, well, seems like really, really challenging for the government. But they have been using the currency policies, and they're actually doing a lot of growth reform. Even for the Bank of Japan, they are trying a lot to do this. How do you think about the effectiveness on all these policies? And do you think that will drive any growth in the economy?
I think if you look at what's happened to Japan over the last couple of years, and you analyze the effectiveness of the depreciation of the Japanese yen, you analyze the quantitative easing, the purchases of assets the Bank of Japan has had, I think you can pretty much conclude nothing has worked at all. They have no inflation, but they were trying to create some. They have very slow growth, but again, Japan is an export country, just like China, and their clients aren't growing, and their monetary policy isn't going to fix growth in the rest of the world. So those policies don't really work. And then, of course, they have a tax increase planned to increase the sales tax. So I think in football terms, we call that an own goal.
Interesting. So seems like there is not too much good news for the Asian markets. So how about the emerging markets? But given you said that maybe most of the economists also expect that there will be slow growth in the Chinese economy and the yen may depreciate further. How would that impact the growth of the other emerging markets countries?
Well, it has contributed to the slowdown, but you have to not be too pessimistic here. What I'm actually saying about China is it's getting to a more realistic growth rate. It could never grow 10% forever. That was just not going to happen. And as its population ages and it's a more modernized country, it's going to have a growth rate more consistent with mature economies. And Japan is the same thing. So these economies are not in recession. They're growing. They're just growing at a slower growth rate than they would like. Now, the rest of the world does have to come to terms with that. For emerging markets, what it means is that there's not a big, strong engine of growth to take them out of their own problems. So they have to look inward and make appropriate reforms in their domestic economies. And every country is different in those regards. Some of them need tax reforms, some maybe need a little trade reform or labor reforms, but they all can improve their own domestic economies. And that's really what they have to do. They just can't look to an engine of growth because the engines have slowed down.
So for the emerging markets, apart from the economy, do you think there will be any rising political risk in that region? And if there is such, how would that impact the equity and currency markets?
Well, political risk is an interesting topic. Political risk tends to rise everywhere that the citizens are disappointed. So if a government promises something and doesn't deliver, it creates political risk for the government. And right now we're in a very slow growth world. So I think you could effectively argue that, well, we probably don't know who's going to be the U.S. president, so that's political risk in its own way. We have plenty of political risk rising in countries that are in recession, Brazil or Russia. We have political risk in countries that are disappointing their citizens. So rising political risk really depends on how it gets handled. And for instance, we had elections last fall in Argentina that produced probably a reform government, and it could actually work out very well for them. Other countries maybe not. But what it does for currencies is it makes currencies riskier where you perceive that the solution to this political risk might not be so good. So it can negatively impact any currency, from the US dollar to the euro to emerging market currencies if political risk rises in that specific country.
I see. So thanks a lot, Blue, to share your view with us today. And to know more about our research reports and our analysis, please go to our website, www.spdji.com. Thank you.